Hi, my name is Daniel Goodman, and I'm the Director of Financial Planning at Sierra Pacific Financial Advisors. We're a boutique fee-only wealth management firm located in Pleasanton, California. So in this month's video, I'd like to discuss the difference between two investment techniques, market timing and dollar cost averaging. First, let's explain what these two investment strategies are. Market timing is the act of moving investment money in or out of financial markets or switching between funds between asset classes based on some kind of predictive model. And it's a strategy that involves buying and selling stocks, bonds, or ETFs based on expected price changes and is often a key component of actively managed investment strategies. Dollar cost averaging involves investing the same amount of money in a target security at regular intervals over a certain period of time, regardless of the price. Through dollar cost averaging, investors put in the same amount of money at regular intervals, monthly, quarterly, or whatever that frequency has been determined, to build wealth over time. Dollar cost averaging can help take the emotion out of investing. It compels you to continue investing the same or roughly the same amount, regardless of the market's fluctuations. So, investors who prefer to pursue the market timing strategy will look at price fluctuations and trends in the market or that target security to determine when to buy or sell. And most often, the market timer will be looking for an opportunity to exit the market when prices begin falling with the desire to protect the gains they've already made. And then they'll wait for the market to begin a rebound, re-enter the market when they believe the rally has become sustainable. The risk with this strategy is the investor may miss the all-important first few days of a new rally. The report Quantitative Analysis of Investor Behavior by the Boston research firm Dalber indicated an investor who remained fully invested in the S&P 500 index between 1995 and 2014 would have earned a 9.85% annualized return. However, if they missed only 10 of the best days of the market, the return would have been 5.1%. However, the market timing strategy can be slightly modified. So instead of exiting the market completely and waiting for a confirmed rally, the investor can instead switch asset classes away from risky assets to less risky assets. And in this way, the investor can protect gains they've earned, but still capture future gains when the market begins to rally. And once the rally has been confirmed, the investor can then rotate back into those riskier assets. So for investors who prefer a more structured and predictable investment strategy, dollar cost averaging is the way to go. So the main benefit of this strategy is that it is automatic and it takes the emotion out of the investment decision. You can kind of think of it of your 401k contribution. That's a type of dollar cost averaging because every paycheck, a certain amount of money comes out and is invested in your account, regardless of whether the market is up or down. This strategy also helps investors avoid the fear of investing all their money at the height of the market, because no one wants to invest a large sum of money on Tuesday just to see it lose 15% of its value on Wednesday. So dollar cost averaging avoids this outcome since the investor only puts in a portion of their cash, say 10 or 15%, each month or every other week or whatever that investment frequency is. Then if the price drops, they can buy more. And if the price rises, they begin to buy into the rise and they enjoy the upward movement. By using dollar cost averaging, investors may lower their average cost per share and reduce the impact of volatility on their portfolios. In effect, this strategy eliminates the effort required to attempt to time the market to buy at the best prices. However, this strategy cannot protect investors against the risk of declining prices in a bear market. So the question most people then ask, which of these two strategies is best? And I would say it depends on the investor and what are their specific goals and tolerance for risk. However, with that said, I don't believe these two strategies are mutually exclusive, and I think an investor can use them in conjunction with each other. So what does that look like? So the way it would work is in times of rising prices, have a consistent plan to invest. That's the key to riding the upward movement. Determine how much of your free cash you want to invest each month, whatever frequency it is that you've set out, and then execute that plan. Waiting to invest the cash, you may well end up missing most of that rally. And then when prices begin to fall, you suspend your automatic purchases. You wait for a day until the markets move down substantially. I usually look for movements of 1% or more. And on these days, you execute another buy order. This is the market timing part of this hybrid strategy. Then you wait for another down day of 1% or more. If it's the next day or a week away, it doesn't matter. You buy again. And then continuing to buy on each significant down day until you are fully invested or you reach some predetermined cash level. Now, you ride out the market, remembering that in the long run, the market is an upward moving beast. So I want to thank you for your time today, and I hope you found this video helpful and informative. We'd appreciate a like and even a subscription. Hit the subscribe button as we do these videos every month. Also, we host a quarterly webinar on topical and relevant finance and investment topics. So our website and contact information is below in the comments. Again, thank you very much for your time, and we'll see you next month.